So you've looked online in 2024 on how to make money. You decide that this is the year that you want to start succeeding. You look into trading. Looks very good. You want to work from home. You can make as much money as you can. But how does option trading really work, and how can we make money from it? With that being said, let's dive right into the video. For this example, I'm going to be using Apple, and we're going to talk about shares, and then we will get into options. So one share of Apple, let's say, cost us $100. So one share cost us $100, and this is Apple at $1 a share, or $100 a share. Okay, so and let's say that we have $1,000 to spend. If we have $1,000 to spend, we can effectively buy 10 shares for $8,000. So just to go over this, we have $1,000 to spend here. We can buy 10 shares at $100 each, giving us effectively 10 shares. So with these 10 shares, we have 10 shares. Our total cost right now is $1,000. So our total cost in is going to be $1,000. Now watch what happens here. If Apple goes up by $1, right? Apple goes up by $1, what happens? This $10 goes to 11, but we have 10 shares, meaning that for this $1,000 that we have put in, we're only making $10 back. Why? Because we only have 10 shares. So whatever shares you have, if the price goes up $1, then you multiply this by whatever amount of shares you have. So if I have 10 shares at $1 each, I only make $10. If I had 100 shares, I would make $100. So you can see the amount of capital you need to day trade or to even swing trade with just shares alone is going to be very expensive, and a lot of people don't have this capital. Now, when we jump into options, this is when we are leveraging our position, meaning that we are borrowing shares, but we're getting it at a fraction of the price. So the same example here, how we just talked about with $1,000, we bought 10 shares. One contract, so in options, it is called contracts, not shares. One contract might cost you, let's say, $250. But each contract lets you exercise 100 shares. So in this example I gave you guys, remember how it was costing us $100 a share? If we do the same math here, if we do 100 times 100, that would equal $10,000. So we would need $10,000 just to be able to effectively buy 100 shares. But with options, with this contract up here, what we can do is we can only spend $250, and we can get the option of having 100 shares in our pocket. So we can trade with 100 shares. We'll only need $250 or whatever the option price is costing us. Now, I'm not going to be going over out of the money, in the money, all that stuff in this video. I'm literally going to be going over bare bones, how options work versus how stocks work, so you guys can understand, because a lot of people don't understand that. So giving you guys a recap, for the first option, we bought 10 shares at $100 each, and we bought 10 of them for $1,000. Now with options, same thing, like we talked about, every option is 100 shares. So let's say that we bought one contract at $250, so the contract cost us $250, and let's say that we only have one contract for $250. Now watch this, I bought 10 shares here for $1,000. Here I'm getting the option to use, so they're not my shares, but I'm borrowing them. I get to borrow 100 shares, meaning that it would cost me $10,000 up here to do the same thing I did with this option. So I'm able to use this contract as 100 shares. So if the stock goes up $1 in a market that doesn't have Greeks and all this stuff, every dollar this stock goes up, I would make $1. So now, for example, let's say that this stock goes up $1. Let's say Apple goes up $1, right? Here, how much would I make? I would make $10 because I only have 10 shares. But here, I'm risking $250. How much am I making? I made $100. So I just made a much bigger gain, and I'm risking way less money theoretically than here, where here I have put in $1,000, but I'm only making $10 back. Here I'm putting in $250 and I'm making $100 back. So you guys can see here that we don't need as much capital, we don't have to risk as much money, and we can also exercise these options. Now every option expires and shares do not. So let's talk about that next. Once you understand that, we're going to talk about shares and options. Now let's talk about the pros and cons. The pros here are going to be that shares, they are much safer, and with options you are limited on time. There's a timeline. So meaning that if an option, the longer you hold an option, it starts losing its value. And remember, it is never yours. The option contracts are never yours. You are just borrowing them, and then there's always an expiration date. So a timeline, what I mean by that is there is a expiration date. So you have to sell it by X, Y, and Z, right? With shares, they're much safer. But the bad thing about it is that the cons is going to be that you need more capital, and the cons with options is they are much more riskier. Theoretically, once you know how shares work, then you should be jumping into options. You should not be jumping into options just because you're seeing your favorite guru making $1,000 or them making a lot of money. Because remember, yes, you might need more capital with shares, but trading options is always going to be much more riskier because you never own the shares. You're on a timeline. You will have to sell those contracts by the expiration date. If you don't roll them over, you end up losing all the money in the option contract. And that's something I'm not going to go over. In this video, I'm just going over bare bones how options work. And so a lot of people want to trade options. You guys want to trade options. You guys want to get into options, but you guys are not understanding how shares work. Just to recap here, remember that one stock, which means a share on Apple, cost us $100. Okay, we have $1,000 here to play with. This is our money. So going over this example, I want to see if you guys got this by the end of this video. If I have $1,000 and the shares of Apple are $100 each, right, I can buy effectively 10 shares of Apple. Now, with the same thing with options, let's do our $1,000. If each option contract costs me $250, how many can I buy? I can buy 4. So I can buy 4 contracts. And that's 400 shares that I am able to trade. Now, once again, we're not talking about delta, theta, anything like that. We are just talking about if we had a market that was perfect. This is not the case, but we're going to give an example, not using anything. So do not eat me out in the comments for not talking about IV and all that stuff and how the value goes down. We're just giving you a plain example here. So we have our 250 per contract. We're exercising. We are borrowing 400 shares. So here for the $1,000, we only got to own 10 shares, but here we're able to do 400 shares for the same $1,000 that we risk. So now, if Apple goes up $1, right? If Apple goes up $1, what happens? Here in this example with our shares, we only make $10. Here in this example with our 400 contracts in a perfect market, we make $400. No matter what, I am only risking $1,000, but in one outcome I made $400, on the other outcome I only made $10. All because I am leveraging my position. To sum up this video, option trading is something that you should look more into. In this next video, I'm going to be going over delta, theta, how options move versus how stocks move. So in this video, we just went over the bare minimum of kind of how stocks work versus options work. This is a very broken down structure, and also remember to take this with a grain of salt because there's no perfect markets. In the next video, as you'll see, if the stock goes up $1, it is never going to be $1. You're gonna have to learn your Greeks, your theta, your gamma, your vega, all that stuff is going to matter. So in the next video, we're going to be going over that. If you did enjoy the video and got some content out of this that actually helped you out understanding options and learned a little bit of something here, if for most of you, I would say 90% of you that do watch my videos, you probably already know how options work, all that stuff. For the ones that are just new and getting into it, because I remember when I was getting into it, this is very confusing. I didn't know the difference between a contract and a share. Why can't I just buy a contract with 50 shares inside of it instead of 100 shares, stuff like that. So I hope this helps break it down, but also remember that with anything that has profit, there's also going to be risk. So this 400 I made, I can also lose 400. I can go into the red and lose 400. This $10 I made, I can also lose $10. So just remember that options are always going to be riskier, but they are always going to have a higher percentage gain back as well. Thank you for watching the video. I'll see you in the next one.